close your eyes for a second and imagine it's 2026. The president walks up to a podium and announces something that sounds amazing. My fellow Americans, I'm proud to announce that we have paid off the entire national debt. America is officially debt-free for the first time since 1835. The crowd erupts in applause. Politicians celebrate. It sounds like incredible news, right? America is finally financially responsible. We're no longer burdening our children with debt. Except, within hours, financial markets start to panic. Treasury bond trading halts. There are no more Treasury bonds to trade. Banks scramble to find assets to hold as reserves. Pension funds face a crisis. They're legally required to hold government bonds, but there aren't any anymore. The Federal Reserve realizes it can't conduct monetary policy because it has nothing to buy or sell. Within days, interest rates spike wildly as markets lose their benchmark. Without the risk-free rate that all other investments are priced against, nobody knows what anything is worth. Corporate bonds, mortgages, student loans all become impossible to price accurately. Within weeks, the banking system begins to freeze up. Banks can't meet their liquidity requirements without government bonds. The repo market, where banks get overnight funding, collapses because there's no acceptable collateral. Within months, the economy is in free fall. Not because the government is irresponsible, but because it was too responsible. Because paying off the national debt removed the very foundation of the modern financial system. This sounds insane, right? How could paying off debt cause a crisis? Isn't debt bad? Here's the thing you need to understand. Government debt isn't like household debt. It's not a burden we need to eliminate. It's the backbone of the entire monetary system. Hey, I'm Brandon, and welcome back to My Money Mint, the channel where I dive into topics related to money and wealth. All right, let's get into it. Let me take you back to 1694 when this whole system began. King William III of England needed £1.2 million to fight France. The traditional goldsmith bankers wanted 20 to 30% interest, and nobody trusted them after King Charles II had defaulted on debts 20 years earlier. So William Paterson came up with a revolutionary idea: create the Bank of England with a loan that would never be repaid. Here's what made it revolutionary. Instead of the king borrowing money and promising to pay it back, the government would pay interest on the loan forever. But the principal would never be repaid. This was permanent, managed national debt. And in exchange, the Bank of England got the right to issue banknotes, paper money backed by the government's debt. This is the key insight. The government's debt became the backing for the currency. The king's IOU wasn't a burden. It was the foundation of the money supply. As one contemporary circular stated, the bank hath benefit of interest on all monies which it, the bank, creates out of nothing. Think about what this means. When the Bank of England issued a banknote, that note was backed by government debt, by the government's promise to pay interest. The debt supported the currency rather than undermining it. And this model spread worldwide. When central banks today issue currency, their balance sheets show government bonds as assets and currency as liabilities. Government debt literally backs our money. Let me show you how this works in the modern system. When a central bank issues currency, here's what happens. The government issues debt, treasury bonds, bills, notes. The central bank accepts this debt as an asset on its balance sheet. The central bank issues currency or bank reserves in exchange. This currency circulates as money in the economy. Look at the Bank of Japan for an extreme example. It owns approximately 440 trillion yen, about 46% of all outstanding Japanese government bonds. The Federal Reserve holds trillions in U.S. Treasury securities. The European Central Bank holds government bonds from member states. This isn't some emergency measure. This is how the system is designed to work. And here's where it gets really interesting. Government bonds serve as bank reserves. Before 2020, U.S. banks were required to hold reserves equal to 3 to 10% of deposits. They could satisfy this through vault cash or reserve balances at the Fed, but guess what else counted? Government bonds. Even after the Fed eliminated reserve requirements in March 2020, banks still need liquid assets. Government bonds are the primary way banks meet liquidity coverage requirements. Without government bonds, banks would struggle to meet regulatory requirements. They'd have no safe assets to hold as reserves. The entire banking system is built on the assumption that government bonds exist and are available. Now let's talk about how central banks control the economy. They do it primarily through open market operations, buying and selling government bonds. When the Fed wants to stimulate the economy, it buys government bonds from banks. It pays by crediting the bank's reserve accounts. This increases reserves in the system, encourages lending, and expands the money supply. When the Fed wants to slow the economy, it sells government bonds. Banks pay by debiting their reserves. This decreases reserves, restricts lending, and contracts the money supply. This is the primary tool central banks use to manage the economy. Without government bonds, the Fed couldn't conduct monetary policy. It would have no way to control interest rates or money supply. Government bonds also serve as the risk-free benchmark that the entire financial system is priced against. Corporate bonds are priced as Treasury yield plus a spread. Mortgages are Treasury yield plus a spread. Stock valuations use Treasury yields in their models. Every single investment is priced relative to government bonds. If government bonds disappeared, how would you price anything? What's the safe rate that other investments should beat? Without this benchmark, financial markets would descend into chaos. Nobody would know what any asset is actually worth. And think about pension funds and insurance companies. They need safe, long-duration assets to match their long-term liabilities. They're often legally required to hold government bonds. Millions of retirees depend on pension funds that hold government bonds. If those bonds disappeared, pension funds would face a catastrophic crisis trying to find alternative investments. Here's something that blows people's minds. There's an accounting identity in economics. The government's deficit equals the private sector's surplus. When the government runs a deficit of $1 trillion, that means the private sector, households, and businesses gains $1 trillion in financial assets. Government debt and private wealth are two sides of the same coin. If the government balanced its budget completely and paid off all debt by accounting identity, the private sector couldn't net save. Think about that. Government surplus equals private sector deficit. During the Clinton administration from 1998 to 2001, the government ran budget surpluses. During that same period, private sector debt increased dramatically. This contributed to conditions that led to the 2008 financial crisis. We actually have a historical example of what happens when you pay off the national debt. In 1835, President Andrew Jackson became the only US president to pay off the entire national debt. He was so proud. But here's what happened next. Without federal debt, the surplus was distributed to states. States deposited funds in banks. Those banks used deposits to fuel speculation, especially in land. A massive land bubble developed. Then Jackson required land purchases be made in gold or silver only. This triggered bank runs as speculators tried to redeem paper notes. Banks collapsed across the country. The result? The Panic of 1837, a major financial crisis and depression that lasted until 1843. Eliminating federal debt removed the safe asset that stabilized the financial system and contributed directly to economic catastrophe. Now, I know what you're thinking. But Brandon, isn't government debt irresponsible? Aren't we burdening our grandchildren? This is where we need to understand that government debt is not like household debt. A household must earn currency it doesn't control. A sovereign government issues the currency it spends. A household has finite lifespan and must pay off debts. A government has perpetual existence and can roll over debt indefinitely. A household cannot tax others for income. A government can. Here's the key difference. When a household takes on debt, it's borrowing someone else's money and must pay it back. When a sovereign government borrows in its own currency, it's issuing financial assets to the private sector. The government isn't really borrowing, it's creating savings vehicles for citizens. Look at Japan with debt at 235% of GDP, the highest in the developed world. The Bank of Japan holds 46% of all government debt. Yet Japan hasn't collapsed. Why? Because 88% of Japanese debt is held domestically. Interest rates are near zero. Japan issues debt in yen, which it controls. The debt is mostly owed to Japanese citizens. The country essentially owes itself. This doesn't mean unlimited debt is safe. Inflation is the real constraint. If government spending exceeds the economy's productive capacity, you get inflation. Interest rates matter. If rates rise, debt service costs increase. Institutional credibility matters. If markets lose confidence, crisis follows. But the constraint isn't some arbitrary debt to GDP ratio, it's real resources and inflation. Modern monetary theory economists make a crucial point. For currency issuing governments, the real question isn't can we afford it, but will it cause inflation? The government can't run out of dollars any more than a bowling alley can run out of points. The constraint is real resources, not money. So here's the bottom line. Government debt serves critical functions in the modern economy. It backs our currency. It provides reserves for banks. It enables monetary policy. It serves as the benchmark for all other assets. It provides safe savings for retirees. It represents private sector wealth. Eliminating it wouldn't make us more responsible. It would crash the entire financial system. The next time a politician talks about paying off the national debt like it's a credit card, remember, they're either ignorant of how the monetary system actually works, or they're pandering to voters who don't understand. Government debt isn't a burden to eliminate. It's the foundation the entire economy is built on. Thank you for watching My Money Mint. If this explanation of why government debt is actually essential got you thinking differently about economics, smash that subscribe button and let me know in the comments. What economic common sense do you want me to debunk next? I'll see you in the next one.